Is the beaten down Nifty IT index about to stage its comeback? Stick around while we break down the next few weeks, few months, and few years. First, the short term, basically the July to August window. The index is ping-ponging between 38.5 and 42.k. Three things will decide which side breaks. Firstly, earnings season. TCS reports first, followed by Infosys and HCLTech. Even flat revenue but a small margin beat could spark a bounce. Second, the chart setup. We finally closed above the 20-day moving average, but sellers are waiting at the 200-day line, right at 41.2. Thirdly, support at 38,200 to 38,500. If that floor cracks, the bulls step aside until 37,800. Trading takeaway: accumulate on dips near support, trail a stop loss below 37,800 and book profits closer to 41,000 if momentum stalls. Zooming out to the 6 to 12 month view, our base case target is 42,000 by calendar year end. Here's why. AI-led wins are starting to offset legacy project slowdowns. Mid-cap outperformers, Coforge and Persistent, keep posting double-digit bookings, hinting at a pipeline rebuild for the whole sector. Valuations have already reset from 2021 bubbles. The index trades at 28.9 times, just a hair above its 5-year median. A mild re-rate to roughly 34 times pushes us to that 42,000 print. Risk monitor. US Fed higher for longer could freeze CIO budgets. If that happens, expect the index to stay range bound between 39,500 to 40,000. Finally, the long term, 2 to 3 years out. Our bull pathway aims for 46,000, which is still below the all-time peak but represents a clean 20+% upside from today. What gets there? A 10 to 12% revenue CAGR as digital transformation, cloud, and GenAI spending normalize. Tier 1 leaders Infosys, HCLTech, and TCS holding or expanding margins thanks to automation and a favorable rupee. Key risks: a deep US recession or rupee appreciation below 82.5. Otherwise, the runway looks clear. So, short-term range trade, mid-term re-rate, long-term growth story, 3 timeframes, 1 game plan. Smash like if this helped, subscribe for more market deep dives, and I'll see you in the next one.